In a world where investing is often made to look complicated, one man proved it doesn't have to be. That man is Peter Lynch, one of the greatest investors of all time. He turned Fidelity's Magellan Fund into one of the most successful mutual funds in history, averaging returns that left Wall Street in awe. In his book Once Upon Wall Street, Lynch doesn't talk in riddles or use financial jargon to confuse you. Instead, he shares simple, timeless lessons from real-life investing, lessons that anyone can understand and apply. This isn't about hype, charts, or market noise. It's about knowledge. Pure, practical, hard-earned wisdom from someone who's been in the trenches. So if you're tired of flashy promises and want real insights that can truly shape the way you think about investing, stay with us. You're about to learn from a master. Welcome to Ease of Education, where knowledge meets clarity and growth begins. We believe true financial freedom starts with the right education. That's why our mission is simple, to bring you deep, meaningful book summaries on the share market that don't just inform, they transform. Our videos may be slightly longer, but that's because we value depth over shortcuts. We focus on giving you the full picture, not just surface-level ideas. No fancy graphics, no unnecessary distractions, just pure, practical wisdom that speaks directly to your goals. Every video is crafted with care to help you build confidence, sharpen your thinking, and take smarter steps toward financial success. Here, it's not just about learning, it's about growing together. Subscribe and let's turn your curiosity into confidence, one book at a time. Once Upon isn't just a book, it's a treasure chest of insight, storytelling, and life lessons. But instead of overwhelming you with long summaries, we've broken it down into short, powerful pieces that deliver real value in just a few moments. Each part gives you something to think about, something to feel, and something to use. Whether you have 2 minutes or 20 minutes, there's always something worth your time. Start now, because sometimes, one small story can change everything. Conviction beats caution. To succeed in the stock market, it's not just about knowledge, it also requires conviction and patience. If a stock's price is falling but its fundamentals remain strong, it's often wiser to hold on to it, or even better, to buy more. However, most mutual fund managers, pension fund managers, and corporate portfolio managers tend to avoid risk, preferring investments where the potential loss is small, even if that means giving up a chance at higher returns. For them, it's more important not to look bad when they fail than to actually succeed. Some of the worst investment behavior can be seen in bank pension fund departments and insurance companies, where stocks are bought and sold only from pre-approved lists, based more on rules than real analysis or potential. In such a climate, if you neither have conviction in the market nor the patience to understand it, then perhaps you shouldn't be involved in the stock market at all. Because in the stock market, it's not just about having a plan, it's about having the belief to stick with it. The market tends to punish the uncertain more than anyone else. Ingredients of winning. Over the long term, common stocks have significantly outperformed other investments, averaging a 9.8% annual return since 1927, far surpassing the returns of corporate bonds, government bonds, and treasury bills. Despite enduring market crashes, economic downturns, wars, and political shifts, stocks have proven to be dramatically more rewarding, yielding returns up to 30 times higher than treasury bills. However, success in the stock market isn't just about timing or picking the right stock, both factors must align. Buying great stocks at the wrong time or poor stocks at the right time can still lead to substantial losses. True investing begins when we accept the inherent risks of money and differentiate it from gambling not by the activity, but by the investor's skill, discipline, and strategy. A wise investor sees each decision as a calculated gamble, striving to tilt the odds in their favor. Successful investors know when to increase their bets and when to walk away, while those who consistently lose tend to hold on out of hope rather than logic. In the end, even a modest success rate, like 6 out of 10 winning picks, can yield impressive results in the market. What is stock market? Before diving into stocks, ask yourself 3 essential questions. Do I own a house? Do I need the money? Do I have what it takes? Owning a house is often the best financial move you can make. It's a leveraged investment, a hedge against inflation, and usually a long-term winner. Once that foundation is set, make sure you're only investing money you can afford to lose without disrupting your life. The stock market rewards patience, not panic. But the real key? It's you. Successful investing demands emotional control, discipline, and the guts to go against the crowd. Don't chase the noise. Tune it out. Trust in fundamentals, ignore the urge to time the market, and let time be your ally. That's how wealth is built. What stock market? Forget the market, focus on what matters. The stock market itself is just noise, a distraction that tempts you to act foolishly. Even Warren Buffett views it merely as a reference, not a guide. Real success comes not from timing the market, but from ignoring it altogether. Pick the right companies, and the market takes care of itself. Some of the best investments happen in the worst markets. If you're waiting for the economy or the indexes to align perfectly, you'll miss the real opportunities, often hidden in overlooked, undervalued businesses right in front of you. Don't try to predict the future. Don't overestimate the experts. Trust what you know, look locally, and think independently. Big wins, and big losses, are both possible in stocks, but long-term, well-chosen investments tend to outperform bonds and beat the odds. This game isn't for everyone, or every stage of life. But if you're in, remember, own companies, not symbols. Ignore the short-term noise. And when you find something great, hold on tight. One sure thing in hand is worth more than 10 maybes in the market. Stalking the 10-bagger. The hunt for a 10-bagger, a stock that returns 10 times your investment, starts close to home. Your everyday life, your workplace, and your local stores are often the best sources of insight. The edge belongs to those who pay attention to what they already know. You don't need to be a tech wizard to win big in tech. Often, it's the users, like companies reducing costs with better equipment, who benefit most and become smart investments. Look for businesses quietly boosting profits through efficiency, not hype. Seek out stocks where the value of the assets per share is greater than the market price. That's your double edge, a hidden advantage the market hasn't caught onto yet. Your greatest investing weapon. Familiarity. When you invest in what you understand, you're already ahead of Wall Street. Understanding the stock spectrum, from cyclicals to turnarounds. In a booming economy, cyclicals shine, rising faster than the dependable stalwarts. But beware, they're the most misunderstood stocks out there. Timing is everything, and getting it wrong can be costly, especially when they seem safe. Turnarounds are the underdogs, struggling companies on the brink, or already in the gutter. But when they bounce back, they do it fast and often independently of the broader market. Spotting a successful turnaround can be your ticket to outsized gains. Asset plays are hidden gems, companies sitting on overlooked value. This is where your local knowledge and unique insight give you a serious edge. These opportunities are everywhere, but only visible to those who know where to look. Finally, remember, companies evolve. Fast growers can become slow movers, high flyers can crash. There's no one-size-fits-all rule for buying or selling. Investing success lies in understanding what kind of company you own, and adapting your strategy as it changes. The perfect stock. The best investments often hide in plain sight, behind boring names, dull products, and industries everyone else overlooks. Simplicity is power. That's why understanding the basic business is key. It's far easier to grasp pantyhose or motel chains than satellites or fiber optics. In fact, the perfect company is often so simple and unsexy that any idiot could run it. Boring isn't bad, it's beautiful. A company with a dull name, doing something dull or even disgusting, can be a goldmine. Funeral homes, toxic waste disposal, or plastic utensils may not excite Wall Street, but their predictability, lack of competition, and stable demand make them ideal long-term plays. These are industries no one's rushing to disrupt, no armies of MIT grads trying to undercut prices. Even better are spin-offs, misunderstood, ignored by analysts, and often priced at a discount. Add in little or no institutional ownership, and you've found a diamond in the rough. A niche helps, too. Whether it's a rock quarry no one can compete with or a trusted brand people return to again and again, exclusivity protects margins and ensures pricing power. Invest in companies whose products people have to keep buying: drugs, razors, cigarettes, or soda. Not tech firms locked in price wars, but businesses like ADP that use technology to boost efficiency and profitability. Finally, when the insiders are buying and the company is buying back its own shares, it's the strongest signal there is. The people who know it best believe the stock is undervalued and are putting their money where their conviction is. In short, the ideal stock is simple, boring, overlooked, indispensable, and quietly unstoppable. Disadvantage of hype. The biggest danger in investing isn't missing out on the next big thing, it's chasing it. If there's one stock to avoid, it's the one everyone's talking about, the hottest name in the hottest industry with the most buzz and the loudest hype. These stocks attract crowds, and crowds attract competition. In high-growth industries, you're not just betting on a business, you're entering a battlefield of brilliant entrepreneurs and relentless copycats. In business, imitation isn't flattery, it's a full-on assault on margins. That's why the smartest moves are often the most contrarian. Forget the next IBM, the next Disney, or any whisper stock that promises the moon on a string. These stories are all sizzle, no steak. They may dazzle with emotional narratives or clever names, but there's usually nothing of substance underneath. IPOs are even riskier, unproven, unstable, and often overhyped. Ironically, it's the boring, unglamorous companies that deliver the most consistent results. Negative growth industries, where no one is rushing to compete, often produce the best investments. They're slow, quiet, and forgotten, but that's exactly what keeps them stable and profitable. In a world chasing flash, real value hides in the shadows. Look past the noise, and don't buy into the next big thing, buy into the quiet thing that works. The real value. It's easy to forget in the rush of market hype, but buying a stock isn't buying a lottery ticket, it's buying a piece of a real business. Every share represents ownership, and with that comes a stake in the company's ability to grow and earn more over time. That's the true bet you're making, not on headlines or momentum, but on future earnings. Understanding that brings clarity. A quick reality check is to compare a stock's price line to its earnings line. If the price is soaring while earnings lag behind, chances are the stock is overpriced. Hype fades, but fundamentals endure. There are only 5 real ways a business can grow its earnings: cut costs, raise prices, expand into new markets, sell more to existing customers, or clean house by dumping what's not working. Everything else is noise. Look for companies doing one or more of these things successfully, and you'll find real value, not just a stock, but a strong business behind it. Scale of company. Before buying any stock, you should be able to deliver a confident 2-minute monologue explaining why you're interested, what needs to go right, and what could go wrong. That discipline forces clarity, and keeps emotion out of the decision. One of the smartest ways to uncover great companies is to listen to the competition. When a rival grudgingly praises another business, it's a powerful endorsement, often more telling than any press release. Every conversation is a chance to learn, and details like customers consistently paying 1,000th the value of a hotel room per night can reveal hidden pricing power and stability. But even the most exciting concept isn't enough without proof. Many companies stumble when trying to clone a local success. Expansion is the true test. It's one thing to dominate in Texas, but does the model work in Maine or Illinois? Until a company shows it can scale profitably, there's no rush to invest. In short, know the story, know the risks, and don't confuse potential with performance. Great businesses earn their way into your portfolio, not the other way around. Chapter 12, Getting the Facts. The truth is, there's very little that the amateur investor can't find out. With a little curiosity and initiative, you can uncover just as much valuable information as the pros. What you don't get from an annual report, you can often find by calling the company, visiting its stores, or just doing some good old-fashioned, kicking the tires. A call to investor relations, with well-prepared questions, can yield real insights. Even asking simple things like, what are the positives this year, and what are the negatives, can reveal a lot. If the company brushes you off, try this: tell them you're a shareholder with 20,000 shares and considering doubling down. Just make sure to say your shares are held in street name. A visit to company headquarters is just as telling. You're not looking for fancy, on the contrary, rich earnings in a modest office often mean the company is focused on performance, not pretense. Likewise, walking through stores, trying the products, observing customer behavior, these grassroots tactics are invaluable. If something's a hit in one mall, it could be a hit everywhere in a country as homogeneous as ours. And remember, in flashy, fragile industries, the sky is always blue, until the storm hits. But in mature, grounded businesses, a little pessimism is often a sign of realism and resilience. The deeper you dig, the more you see what others miss, and that's where great investments are found. It starts with context. Behind every good stock is a good business, and understanding that business means digging deeper than just the name or the buzz. It starts with context. If a company's hot product catches your eye, the first thing to ask is, how much of the company's total sales does it represent? A great product that makes up only 2% of revenue might not move the needle. Then comes the math. A solid price/earnings ratio should ideally be lower than the company's growth rate. Half is excellent, twice is a warning sign. But don't stop at earnings. Look at cash flow, especially free cash flow, the money left after capital expenses. That's the real fuel behind business growth or shareholder rewards. A stock trading at a steep discount to its cash flow is often a goldmine. Balance sheets matter. Debt is the make or break factor in tough times. Funded, long-term debt is manageable. Bank debt, especially short-term or callable loans, can cripple a company fast. Check if they have enough cash to cover short-term obligations, and avoid companies that live on borrowed time. Be wary of book value, it often tells a misleading story. Many hidden assets, like land, patents, or cable rights, are carried at historic cost and don't show their true worth. Even tax breaks can quietly boost value, especially in turnarounds. Inventory can be a warning sign. If it grows faster than sales, the company may be headed for trouble. And don't ignore pension liabilities, they're just as binding as bond payments. The growth rate is your compass. A company that can raise prices without losing customers, like a brand with addictive power, has a rare advantage. Combine that with strong profit margins, and you've got a long-term winner. But in a turnaround, look for the opposite, a low-margin company with room to rise. In the end, great investing is a balance of stories and stats, of strategy and skepticism. When the numbers and the narrative align, you've found something special. Rechecking the story. Even after buying a stock, the research doesn't stop. Every few months, it's essential to revisit the company's story, especially for fast growers. Growth companies evolve in phases, and knowing which phase your investment is in makes all the difference. The startup phase is full of potential but heavy with risk. This is where the company is still ironing out its core business model. The rapid expansion phase is the sweet spot. The company has momentum, is scaling into new markets, and the upside is greatest with the least uncertainty. Finally, the mature or saturation phase brings new challenges. Growth slows, competition rises, and the company must reinvent itself or risk decline. The key is recognizing when the narrative changes, and having the discipline to act on it. Great investors don't just buy stocks, they stay in tune with the businesses behind them. The practical checklist. Investing in stocks isn't a lottery, it's owning a piece of a real business. That means doing your homework. The best investors treat stock picking with the same seriousness they'd use to buy a new car or refrigerator. Here's how to think like one. Start by categorizing your stocks: cyclicals, fast growers, turnarounds, stalwarts, asset plays, because your expectations depend on the type. Big companies move slowly, small companies can explode. Understand the nature of the business and why you're buying the stock. It's going up is not a reason. Evaluate the fundamentals. Is the P/E ratio reasonable relative to growth? Are earnings consistent or erratic? Is there a strong balance sheet, manageable debt, and good cash flow? Is insider buying happening? Is the company buying back shares? What's the institutional ownership? Lower is better. Less attention means more opportunity. With cyclicals, remember, the darker the slump, the brighter the rebound. With fast growers, aim for 20 to 25% earnings growth. Be wary of those growing faster than that, it's often unsustainable. Make sure the growth is replicable, not a one-hit wonder. Avoid the hype. Hot stocks, whisper tips, exciting names, and the next big thing often turn into big disappointments. Trust your own research, not the crowd. Especially avoid diversifications and long shots, they rarely pay off. Invest in boring, simple companies with strong niches, low competition, and dependable demand. When growth slows, focus on companies that can still raise prices without losing customers. Companies with no debt can't go bankrupt, always a plus. And don't forget to track your story. Every investment should have a clear narrative you can follow and reevaluate over time. Devote at least an hour a week to real research. Kicking the tires, asking good questions, and studying the balance sheet are your greatest advantages as an individual investor. Because when you truly understand what you own, you're no longer just holding a stock, you're holding opportunity. As we close the final chapter of Once Upon Wall Street, we're left not just with the story of a market, but with the story of ambition, risk, and transformation. This book takes you beyond the graphs and jargon. It unveils the human drama, the strategic genius, and the cautionary tales that shape the stock market. It's more than finance, it's life, told through the lens of Wall Street. If this journey sparked your curiosity, made you think differently about investing, or simply entertained you with the highs and lows of market legends, then hit that subscribe button. Because this is just the beginning. What's next? Let's keep the momentum going. Tell us, which legendary book should we break down next? The Intelligent Investor by Benjamin Graham? Reminiscences of a Stock Operator by Edwin Lefebvre? Common Stocks and Uncommon Profits by Philip Fisher? Drop your pick in the comments, we'll dive into the one with the most love. Until then, stay curious, stay invested, and remember, every market has a story. Let's keep reading them together.